Imagine this. You buy silver as protection against inflation. You invest your savings and wait for the price to rise. But the price does not rise for years, even when all economic factors suggest it should soar. Why? Possibly because someone very influential does not want it to rise. Today, we will talk about one of the most scandalous accusations in the history of financial markets. Does the largest bank in America, JPMorgan Chase, manipulate the price of silver? This is not a conspiracy theory from dark internet forums. These are accusations backed by evidence, court cases, multi-billion-dollar fines, and admissions of guilt. Fasten your seatbelts. We are diving into a world where banks play against you, traders go to prison, and the government looks the other way, as long as it benefits them. Let us start with the basics. What is market manipulation in silver in general? Silver is traded on exchanges, mainly on COMEX in New York and the London bullion market. That is where the global price is set. But here's the problem. Most trading is not physical silver, but paper contracts. Futures, options, derivatives. According to some estimates, for every ounce of physical silver, there are 100 to 200 ounces of paper silver. It is like a casino where you have a chip, but the casino vault does not contain real money to back it. As long as not everyone demands payment at the same time, the system works. But if everyone suddenly wants to exchange paper for metal, there is a collapse. And this is where JPMorgan appears. Since the early 2000s, the silver community, investors, analysts, traders, began to notice strange patterns. The price of silver should have been rising. Demand was increasing, supply was shrinking. But every time the price started to surge, the same thing happened. A sudden crash. Sharp, massive, illogical. Who was selling at those moments? Large banks, first and foremost, JPMorgan Chase. The year 2008 marked the beginning of the scandal. Trader and analyst Andrew Maguire publicly accused JPMorgan of manipulation. He claimed that the bank used algorithms to suppress the price of silver through massive short selling on COMEX. A short sale is a bet on a price decline. You sell something you do not own, promising to buy it back later at a lower price. Maguire even predicted the exact timing of the next manipulation and sent a letter to the regulator, the Commodity Futures Trading Commission. And what happened? The manipulation occurred exactly on schedule, but the commission took no action. In 2010, Bart Chilton, a commissioner of the commission, publicly stated, "I believe there were attempts to manipulate the silver market," a rare admission from an official. But the investigation dragged on for years. No consequences followed. In 2013, silver had previously reached a historic high of around $50 per ounce in April 2011, but then suddenly collapsed. In a single day, May 2nd, 2011, silver fell by 12%, with no news, no reasons. Just enormous volumes of selling on COMEX within a few minutes. Who was selling? Large banks with short positions, JPMorgan among them. Investors around the world lost money, but the banks made billions because they had bet on the fall. Okay, accusations are one thing, but is there evidence? It turns out there is, and it is documented, verified, and has led to court cases. Let us examine how exactly JPMorgan manipulates the price of silver. One technique is spoofing, the use of fake orders. This is a method where a trader places enormous buy or sell orders, creating the illusion of demand or supply. Other market participants see this and react, starting to buy or sell. The manipulator then cancels the order at the last moment and profits from the price movement that he himself created. In 2019, the United States Department of Justice officially charged JPMorgan traders with using spoofing in precious metals markets, including silver. This was not a conspiracy theory. These were official charges. Specific names were identified. Michael Nowak, managing director of JPMorgan's precious metals desk. Greg Smith, executive director. Christian Truns, a hedge trader. These people worked at JPMorgan for decades. They were not rogue fraudsters. They were top managers of the bank. What exactly did they do? Court documents show that JPMorgan traders placed fake buy or sell orders for thousands of contracts in silver, gold, and platinum. The goal was to move the price in the desired direction. Then, they canceled the orders milliseconds before execution. This happened thousands of times from 2008 to 2016. Not an accident, a system. Another element was short positions, a bet on falling prices. JPMorgan for years held one of the largest short positions in silver on COMEX. This means the bank had bet billions of dollars that the price of silver would fall. Now the question is simple. If you have a massive short position and you can influence the price through spoofing and large-scale selling, what will you do? You will push the price down to win your bet. Data from the Commodity Futures Trading Commission shows that in the period from 2010 to 2013, JPMorgan controlled up to 25 to 30% of all short positions in silver on COMEX. One bank, a quarter of the market. This is a concentration of market power that allows price control. Another tactic was massive sell-offs at key moments. Large volumes of contracts were sold suddenly during periods of low liquidity at night or on weekends when Asian markets were closed. For example, on a Sunday evening when most traders are asleep, 5,000 to 10,000 silver contracts are suddenly sold on COMEX within a few minutes. This is equivalent to 25 to 50 million ounces. The price collapses by 2 to 5%. A normal investor or company would never sell like this because it destroys the price and causes losses. It only makes sense if the goal is to suppress the price for other reasons. Who carries out such sell-offs? Banks with short positions, JPMorgan among them. Evidence from the data shows that researchers analyzed COMEX data from 2008 to 2014. The result was that more than 50% of the largest one-day silver price drops occurred during periods of low liquidity and were caused by massive sales from a small number of market participants. Coincidence? Statistically implausible. There were also confessions and insider testimony. In 2018, former JPMorgan trader John Edmonds testified against the bank. He confirmed that spoofing was standard practice. Management knew it was encouraged. In 2019, another bank trader pleaded guilty to fraud and manipulation charges. He agreed to cooperate with investigators. These people are not inventing stories. They were inside the system. So the evidence exists. The charges have been brought. What comes next? Punishment? Not quite. In 2020, there was a historic admission of guilt. In September 2020, JPMorgan Chase officially pleaded guilty to manipulation in precious metals markets and United States Treasury bond markets. The bank agreed to pay a fine of $920 million sign. Almost $1 billion sign. This is the largest fine in history for manipulation of commodity markets. It sounds like a victory, right? But let us dig deeper. First, no one went to prison. JPMorgan is a corporation. A corporation cannot be put in prison. The top managers who approved these strategies did not bear personal responsibility. Michael Nowak and Greg Smith were charged, but the cases dragged on. Nowak was acquitted by a jury in 2022, Smith as well. The system protected its own. The only people who went to prison were rank and file traders. Christian Truns received 1 year in prison. Another trader, not from JPMorgan, but connected to a similar scheme, received 2 years. But the people who gave the orders ? Those who earned millions in bonuses ? They are free. Second, the fine is a drop in the ocean. $920 million sign sounds impressive. But let us look at the context. JPMorgan Chase annual profit in 2020, $29.1 billion sign. The fine is 3% of annual profit for a decade of manipulation. If you earn $100,000 sign per year and you're fined $3,000 sign for stealing for 10 years, would you stop ? Or would you simply consider it a cost of doing business? ? JPMorgan is not bankrupt. Shareholders were not hurt. The bank continues to operate as usual. Third, the money did not return to the victims. The fine was paid to the government. Investors who lost money because of the manipulation ? They received zero, nothing. Class action lawsuits were filed by affected investors. In 2016, a group of investors sued JPMorgan demanding compensation for losses. The case dragged on for years. In the end, JPMorgan agreed to a settlement of $50 million sign in 2020. $50 million sign for thousands of victims. After deducting attorney's fees, each investor received pennies on the dollar of losses. Other banks were also guilty. JPMorgan was not alone. Other major banks were also caught. Deutsche Bank was fined $30 million sign in 2016 for manipulating the price of silver. UBS, HSBC, and Bank of Nova Scotia settled lawsuits for tens of millions. The pattern is obvious. The world's largest bank systematically manipulated the precious metals market. They were caught, fined, and continued operating. Why did regulators remain silent? ? This is where it gets most interesting. The Commodity Futures Trading Commission, the United States Commodity Markets Regulator, received complaints about silver manipulation starting in 2008. Andrew Maguire provided evidence. Bart Chilton, a CFTC commissioner himself, publicly spoke about manipulation, but the investigation moved at a snail's pace. Why ? One theory is regulatory capture. Many top CFTC officials come from major banks and return to them after working at the regulator. This is called the revolving door. It is difficult to aggressively prosecute banks if your next job might be at one of them. Another theory is systemic importance. JPMorgan is not just a bank. It is a systemically important financial institution. In 2008, the United States government rescued the banking system, injecting trillions. JPMorgan was a key player. The government depends on these banks for financial system stability. Aggressive prosecution of JPMorgan could destabilize the system. Therefore, the fine is a compromise. We caught you, pay, and let us move on. A third theory is that suppressing the price of silver benefits the state. This theory is more conspiratorial, but it has logic. If the price of silver and gold soars, it signals that people do not trust fiat currencies, including the United States dollar. This undermines trust in the government and the Federal Reserve. Keeping precious metals prices low is a way to maintain the illusion of dollar stability. Regulators may turn a blind eye to manipulation because it benefits the system. There is no proof, but there is logic. All right, manipulations did happen. Banks were fined. But what is happening now? Is manipulation still continuing? Here is where the story becomes truly interesting. After 2013, JPMorgan started doing something strange. The bank began massively buying physical silver. Data shows that from 2011 to 2020, JPMorgan accumulated about 1 billion ounces of physical silver. This is the largest stockpile in private hands. For context, annual global silver production is about 800 to 900 million ounces. One bank holds more silver than is mined in a year. What does this mean? The theory of the silver community is the following. JPMorgan suppressed the price of silver for years through short positions and spoofing in order to buy physical metal cheaply. This is called accumulation at the bottom. The logic is simple. Keep the price low through manipulation. Buy physical silver cheaply. Close short positions. Allow the price to rise. Sell the physical metal with enormous profit. It is a brilliant strategy if you have the resources and power to manipulate the market. By 2020, JPMorgan had significantly reduced its short positions on COMEX. Coincidence? Or preparation for price growth? Since 2020, the price of silver began to rise. From $12 sign in March 2020 to $30 sign in February 2021. Then a pullback, but the overall trend is upward. Industrial demand is growing. Solar panels, electric vehicles, 5G. Physical shortages are increasing. Investors are returning to silver as protection against inflation. But there is a problem. The paper market still controls the price. As long as COMEX exists with its 100-to-1 ratio of paper to metal, manipulation is possible. In January and February 2021, the Reddit community attempted a silver squeeze. People tried to buy physical metal and drain inventories to expose shortages and force prices higher. Thousands of people bought coins and bars. Dealer inventories fell. But the price on COMEX rose only slightly and quickly pulled back. Why? Because the paper market dominates. As long as people trade contracts instead of demanding physical delivery, banks control the price. As of 2024, silver trades around $23 to $28 sign per ounce. This is below the historical high of $50 sign in 2011, even without adjusting for inflation. Short positions on COMEX still exist, although they are smaller than in the 2010 years. New players, new algorithms. But the mechanism is the same. There are signs of continued manipulation. Sharp drops without reason still occur. During periods of low liquidity, the price can still fall by 2 to 5% in minutes. Physical premiums are detached from exchange prices. Coins and bars are sold at premiums of 30 to 50% above the COMEX spot price. This is a sign of physical metal shortages. The gold to silver ratio remains consistently high. Historically, silver traded at 1/15th to 1/20th of gold. Now it is 1/80th to 1/90th. This is an anomaly. So what does all this mean? Are JPMorgan and other banks manipulating the price of silver? Yes. This is documented, proven, and recognized by courts. Is it continuing today? Probably. The mechanisms are the same, the incentives are the same, and the punishments are symbolic. What should an investor do? If you believe in silver, buy physical metal, not paper. Coins and bars, not exchange-traded funds or contracts. Paper can be manipulated. Physical metal is in deficit. Think long term. In the short term, banks control the price. In the long term, fundamentals win. Be prepared for volatility. Manipulation creates sharp moves. Do not panic. If you're skeptical, avoid silver. Why play a market where banks with trillions of dollars sign are against you? The main lesson is this. Markets are not free. They are controlled by those who have capital and power. JPMorgan and other banks play by their own rules. Regulators are part of the system, not a counterbalance to it. Fines in the billions are not punishment for banks with profits in the tens of billions. They are the cost of doing business. The system is not broken. It works exactly as intended, in favor of those who control it. So, yes, JPMorgan manipulates the price of silver. They were caught, fined, and most likely continue to do it today. The question is not whether they manipulate. The question is what you are going to do about it.